Okay, good day. Frank Apodaca.
Jordyn Ross.
We're here to talk about something so exciting, taxes.
Yay!
Yeah. I'm going to get all hot and bothered talking about it. So primarily focus on real estate and mortgages. So Jordan's here to sort of talk about some of the different types of forms that we see regarding people's tax returns and why it's so important that they get done properly and sort of the consequences, I guess we can say that, right? If people do not claim enough income on their tax returns and how it affects them applying for a mortgage. Before I let her talk about that, a piece of trivia that 35% of the population of the United States is considered self-employed, whether it be 1099 or some form of income like that. And that's a huge percentage. So the question is, how do those consumers get qualified for a mortgage? So that's what we're going to talk about a little bit now. Mm-hmm. So Jordyn, what are some of the forms that you've seen self-employed individuals fill out paperwork for over the span of the years? I'm talking about S Corps and C Corps.
Yeah.
Your turn.
Definitely. Yeah, so a lot of borrowers would be your typical either have an LLC or are just independent contractors. They either get issued a 1099 miscellaneous or some other form of 1099 income. Mm-hmm. What they do then is report it on just a Schedule C, which is in your 1040. Mm-hmm. So there you write your gross income, you deduct any expenses. They also have they also have depreciation or supplies, meals and expenses, and then you get your net income at the bottom. You then also have your more established businesses that are usually in about an S Corp. You're going to have a whole separate return for that. You're going to have what's called an 1120S, so the entire corporation is going to file. All income at the end of the day passes to its partners, or its business owners in a K1. And so that was where the owner then claims any income from that K1 that's left over at the end of the year. Bigger S corporations would also be issued W-2s through their S corporation through the years as well. So even though they're a business owner, they would get their own W-2 along with a K1 at the end of the year.
So the point of this is that it's our jobs as lenders to undo the cobweb that clients and their CPAs or tax accountants or financial planners or attorneys have put together over a span of a period of time. Could be years, many years. And it's our job to try to derive as much income as we possibly can from those clients' returns, if you will. And again, to no disrespect to clients, their jobs are just sort of hand over their information to their CPAs, and then CPAs say, okay, well, how much money do you want to pay to the IRS? And they sort of adjust their income accordingly. But when it comes to lending, whether it be you're applying for a standard Fannie Mae, Freddie Mac, a conventional type loan, even commercial financing or non-QM type loans, we'll talk about in a quick moment, it becomes very troublesome for us to derive income when a client says, I want to buy a home of this size. However, their tax returns show that they can only qualify for a home of this size. So then what do we do? So I want to bring up a quick example of why Jordyn is so important, being a CPA, is that describe what happened with that Michigan client. They got declined from another lender.
So a lot of times when you're looking at returns, a lot of people just look at the net income. Clients may only claim so much income, but then you really got to dig into what are they actually expending, because they really had a gross income of, say, $300,000, but they're only claiming $30,000. What are they expensing to get down to that net number? There are potential add backs that you can deduct for tax purposes, but for lending purposes, we can add that income back. A big one is going to be depreciation. Depreciation is where a lot of clients can depreciate a new truck that they bought, a new storage center, a new, you name it, a lot of mechanical suppliers or anybody that has a lot of cost of goods sold will have a lot of some depreciable assets, just holding supplies and whatnot. So depreciation can be a great way for tax purposes to not have to claim income that year, whether it be a big 179 deduction where you depreciate an asset full out, you buy a new building, you can start depreciating it on its applicable depreciation schedule. But that's a big one where we can add that income back. Yeah. But there are items that we can't add back if you deduct a lot of meals and entertainment, supplies, a lot of just miscellaneous expenses throughout the year. Another one we can add back is if you claim mileage on your car. So when you're looking at, say, just a Schedule C LLC client or independent contractor, if you only use your line item car and truck expense and say you just throw in $5,000, we can't add that back. you have to go on page 2 of the Schedule C, I think it's line 44, and add back and actually calculate your mileage. If you calculate that specific mileage, we can add that back into your income. So those items are very important when we look at returns, that maybe your net income doesn't show that on the tax return, but there are potential add backs.
You lost me at, hi, my name is Jordan. So anyway. Wow, all right, I don't know about you all, but that's, all this talking numbers gets me hot and bothered. I swear to goodness. Woo, it's warm in here. So anyway.
I gotta go amend my return.
God, it's hot. Woo! So tax numbers, all that kind of jazz. But there's a moral to the story and the point, and the reason why I'm having Jordan talk about these kind of things, and I can't emphasize this enough, when I go back to those stats, about 35% of consumers are considered self-employed in the United States. A lot of those consumers get discouraged. Is they might have great credit scores, they might have a lot of assets, but yet they're like, well, I can't qualify for a mortgage because I tried before. That gentleman got declined from another lender. They didn't understand how to adjust the tax returns, correct? So we were able to add income back, and therefore that turns into a transaction, which makes everybody very happy. So let's say, as an example, the client, we cannot add enough income back into their tax returns, or just show as an adjusted net to help them qualify for standard typical mortgage. A lot of people are not aware of what we call non-QM loans. Non-QM loans have filled a huge niche for those self-employed borrowers around the United States for the last 2.5 years. We here at Bear Financial have 10 different non-QM banks that we work with. What we do is we actually send out a sort of a snapshot, a goal of what the client's looking for. I'm trying to buy a home at this sales price. I got this credit score. I got this down payment. What can we do? So then we shop it for the client. And those programs are specifically tied to not requiring people's tax returns. This is a huge, important thing. We've done so many loans for clients that are general contractors, real estate agents. I can go down the list of what they do, and they might have adjusted gross receipts of $300,000, $500,000, but their adjusted gross income is so far down here, and we cannot add enough income back to get them to qualify for a standard mortgage. So that's why these other programs come into play. All we do is average their income from whether it be 6 months or 1 year, and we just take an average of their income on their gross receipts that get deposited into their bank accounts. And we are able to finance them based on those numbers and not what standard shows up on tax returns. So those non-QM loans are huge for people that are self-employed. People get discouraged, as I mentioned earlier, about, well, I cannot qualify because I went to my standard bank and got denied or declined. But we do have avenues for those types of clients. So anyway, that's pretty much what I have about non-QM and that lovely warm talk of taxes and depreciation and add backs. Oh, it's hot here.
Getting crazy things.
Crazy things. So anyway, again, Frank Apodaca.
Jordyn Ross.
Thank you. Till next time.